America's first banking blind spot. At the moment the system believed it had finally mastered stability, it quietly stopped seeing its own weaknesses. Confidence settled in, not because danger had disappeared, but because everyone assumed it had been accounted for. And that assumption became one of the most expensive mistakes American banking ever made. To understand how this blind spot formed, we have to step back to a time when regulation itself felt like a solution rather than a tool. A moment when lawmakers, bankers, and the public believed the hardest problems had already been solved. Because the same belief still shapes how risks are misunderstood today. In the early structure of American banking, danger was easy to identify. Bank runs were visible. Failures were local. Panic moved slowly enough to be recognized before it spread. This made risk feel tangible. If a bank took reckless bets, depositors noticed. If confidence weakened, withdrawals followed. Cause and consequence remained closely linked. So regulators focused on what they could see: capital levels, reserve requirements, clear institutional boundaries. These were designed to stop familiar threats from repeating. And for a time it worked. Banking became calmer. Failures declined. Public confidence stabilized. But stability created a new problem. Attention narrowed. Oversight became focused on past dangers, not emerging ones. Risks that didn't resemble earlier crises received less scrutiny. As financial markets evolved, banks adapted faster than the rules governing them. New instruments appeared. New funding structures formed. New dependencies grew quietly between institutions. None of this looked immediately dangerous. Balance sheets still met requirements. Liquidity still appeared sufficient. Losses still seemed containable. The system was watching the wrong signals. It tracked solvency but not speed. It measured capital but not interconnectedness. It monitored institutions but not behaviors moving between them. This was the blind spot forming, not from negligence, but from confidence, from the belief that visible stability meant underlying safety. Banks learned to operate inside those assumptions. As long as they complied with existing rules, risk felt permissible. Innovation filled the gaps oversight didn't see. What regulators missed was subtle but critical. Risk was no longer sitting inside individual banks. It was forming between them, in shared exposures, in synchronized behavior, in assumptions no one questioned because nothing had failed yet. By the time anyone noticed, the structure was already set. The blind spot wasn't a gap in regulation. It was a gap in imagination. And once a system stops imagining new danger, it guarantees surprise when danger finally arrives. Once the blind spot settled into place, it quietly reshaped how risk was interpreted across the entire system. Not ignored outright, but filtered through assumptions that no longer match reality. What could not be easily measured slowly stopped being feared. Banks learned how to operate comfortably inside this narrowed field of vision. If capital ratios met expectations, confidence followed. If liquidity models showed resilience, concern faded. Compliance became proof of safety, even when behavior changed underneath. This encouraged a specific kind of innovation, not reckless experimentation, but strategic adaptation. Banks structured activities to fit regulatory categories while expanding exposure elsewhere. Risk was not eliminated. It was repositioned. Complex funding chains grew longer and more interconnected. Short-term borrowing supported long-term commitments. Institutions depended on markets remaining liquid at all times. Yet these dependencies rarely appeared in traditional stress scenarios. From the outside, everything looked orderly. Markets functioned smoothly. Volatility stayed low. Failures remained rare. Inside the system, however, fragility was accumulating. The same strategy spread across institutions. The same assets filled balance sheets. The same assumptions governed decision-making everywhere. Diversity, once a natural stabilizer, quietly declined. Different banks began reacting to signals in the same way. Hedging strategies aligned. Risk management converged. The synchronization was invisible to oversight. Each institution appeared sound in isolation, but collectively, they were becoming vulnerable to the same shocks. The blind spot widened without triggering alarms. Meanwhile, confidence deepened. Past stability reinforced belief in existing safeguards. Every calm year confirmed the system's design. Warnings felt theoretical, detached from lived experience. Those who questioned the structure struggled to gain traction. There was no crisis to point to, no failure to explain, only abstract concerns about what might happen under stress. As a result, correction was deferred. The system chose continuity over uncertainty. It favored predictability over imagination. And imagination was exactly what it needed most. Risk was no longer something that announced itself clearly. It was something that accumulated silently, waiting for a moment when the blind spot would finally be exposed. The conflict emerged the moment stress began testing assumptions the system no longer questioned, not as immediate collapse, but as confusion about why familiar safeguards were no longer working. Signals that once warned early now arrived too late. Small disruptions started behaving unpredictably. Markets that were assumed to be liquid hesitated. Funding channels that were considered reliable tightened without warning. Confidence weakened faster than models predicted. Banks reacted by following established playbooks. They raised capital. They reduced exposure. They sought reassurance from markets and regulators. But these actions were synchronized. What was meant to stabilize instead amplified pressure. Selling became contagious. Hedging increased correlations. Protective behavior produced the very volatility it was meant to prevent. The blind spot revealed itself through speed. Events unfolded faster than oversight could respond. Information moved instantly. Decisions cascaded before interpretation could catch up. Institutions that looked healthy days earlier faced sudden stress, not because assets had failed, but because assumptions had. Liquidity depended on confidence, and confidence depended on everyone believing at the same time. Regulators found themselves reacting to symptoms, not causes. Support mechanisms activated. Emergency facilities expanded. Reassurance became policy. But each intervention exposed the limitation of prior oversight. The system had been designed to manage known risks. It was now confronting behavior-driven instability, something rules alone could not contain. Banks realized they shared more exposure than expected. Connections once considered minor became critical pathways for stress. Interdependence replaced independence almost overnight. This was the core conflict. A system built to monitor institutions was facing a crisis rooted in collective behavior. No single balance sheet explained the danger. The threat lived in alignment. By the time clarity emerged, options had narrowed. Allow disruption to spread, or intervene decisively and reinforce the structure. Either choice confirmed the blind spot. Risk had not been miscalculated. It had been misunderstood. The climax arrived not with shock, but with recognition. The system finally saw what it had been missing all along. The greatest risk was never inside individual banks. It lived in how they moved together. Years of calm had trained institutions to behave similarly. The same models, the same assumptions, the same reactions under pressure. Uniformity replaced diversity, and diversity is what absorbed shock. When stress appeared, there was nowhere for it to dissipate. Protective instincts aligned. Liquidity vanished simultaneously. Confidence collapsed not because fundamentals failed, but because belief fractured everywhere at once. This was a blind spot fully exposed. Regulation had focused on strength and isolation, while vulnerability formed collectively. The system was stable on paper, yet brittle in motion. Intervention became unavoidable. Support flowed quickly. Markets stabilized. But the lesson was uncomfortable. Stability had masked fragility. Rules had shaped behavior too precisely. By preventing old failures, the system created new ones. Failures that emerged from coordination rather than collapse. The resolution is not about abandoning safeguards. They remain essential, but safeguards must evolve with behavior. They must account for speed, alignment, and shared assumptions. Today, the same question still lingers. Are we measuring the right risks? Or are we protecting against the last crisis? While the next one forms just outside our field of view, American banking continues to operate inside this tension between safety and blindness, between control and complexity, between confidence and surprise. Sometimes the smallest shift in perspective becomes the beginning of a new future. America